Welcome to our little short take that we have. Today, we're going to be talking about Mind the Gap. Okay. Today's information the information contained in this presentation should not be construed as a recommendation or an offer to buy or sell any financial instrument or any security. Additionally, information contained in the presentation does not imply the suitability of any investment strategy. We are not licensed brokers or investment advisors. All attendees of the presentation and purchasers of our content are encouraged to speak with a licensed representative regarding the appropriateness of investing or trading of any investment or any trading strategy. We are using real-time market data and will be executing trades in a simulated account during our presentations. No offer on our part with respect to the sale or purchase of any security is intended or implied, and nothing contained in here should be construed as a recommendation to take a position in the market. The intent of this information is for instructional and educational purposes only. Any fair use of third-party trademarks or logos does not apply in affiliation or sponsorship. All trading does involve high risk, past performance, not indicative of future results. We make no promises, guarantees, warranties, suggesting that any information shared will result in a profit and not in a loss. You agree to not hold us legally, financially responsible for any reason. So what is gap in trading? Mind the gap, okay? A gap is price gaps represent the strongest, most visible imbalance between buy and sell orders, okay? Now, let's just imagine a trader, a floor trader, okay, coming to the trade desk in the morning, about 2 hours before the regular session opens. Now, orders have come down from upstairs and they're sitting on the desk to either have a buy or sell or, type orders. So the floor trader is kind of organizing those and kind of placing stacks. Okay, I got some buy orders over here. I got some sell orders over here. Okay. Now, when the trader arrives at the desk and we see where the last traded price is, but the buy orders are way down below or the sell orders are way up above, there's no way to make transactions there. Okay. So what happens is that when the specialist kind of walks over and the floor trader is kind of pulling the guy over and said, hey, I've got no buy orders at where price is trading right now. Okay. So what they'll do is adjust price up or adjust price down to make a market. Okay. So big price gaps up or down are a result of a gap up is there's no sell orders. So price had to shoot, they had to adjust it up to match up the sell orders. Or there was no buy orders and price had to drop right down to find real buyers in order to make a market. There are many reasons that traders speculate on what is a gap. And when you pull the curtain away and look behind, you will see that a gap is just simply an imbalance of buy orders versus sell orders. Okay. And price being adjusted down or up to get the market trading. So many reasons as to why a gap has occurred, such as news or economic announcements, rollover gaps. Basic fact is there are no pending orders at that price range. And these act as a magnet for price. When price returns to these areas, we anticipate there's still to be a large amount of leftover orders. When price drops down and finds that stack of buy orders, okay, and then shoots back up, okay, we anticipate that the stack of orders is still there, okay? There are some leftover orders. So when we're looking at charts, we need to know what type of gap we are looking at, okay? But a gap is just that empty space on a price chart, okay? Now, the origin of a gap up, okay, price gapped up because we had so many buy orders and no sell orders. Price gapped up looking to find the sellers. When price returned to the origin of that gap up, okay, or there were still leftover unfilled orders. That's why price comes out of these areas, filling the gap. In this example here, we had a gap up in price. Again, we didn't have any sell orders, so price had to gap up to the area where we found sellers. Now take a moment and look at the whole setup. What does the picture on a price chart look like on the left-hand side of the chart where price changes direction? I mean, we see the price gapped up in this example right over here. Therefore, there must have been more sell orders still parked over buy orders. Okay. And for this gap up, okay, strong gap up, never came back. But when it did come back to that area, the resistance, the buy territory, okay. And by the way, this is the same chart if you look at it, okay. Because this is where the gap down is over here. It's kind of connecting to the charts here. But these are places where a gap occurs because of a large imbalance between buy orders and sell orders, okay? So let's explore a couple of types of gaps. We have a natural gap, okay? And a natural gap is just price adjusting up or adjusting down from one session close to the next session open, okay? A rollover gap is not something that I tend to trade, but on a lot of our commodity or futures commodities, we do see rollover gaps. On the commodities, we see the gaps, rollover gaps occur just about every month on those products. And on our financial products, we often see that the bigger gaps occur around that contract rollover, okay? Now, rollover gaps, you have to know the difference because a gap looks like any other gap. A natural gap looks like a rollover gap. But the rollover gaps happen at specific times right around contract rollover when the front month contract is expiring and we're going to the back month or the new front month, okay? Today, we're going to cover a couple of other gaps and their personalities. We have breakaway gaps. Now, a breakaway gap is really simple. It breaks away from an existing trend. For me, a trend is identified, 2 points identify it, 3 points confirmed. So I like to see a break of a confirmed trend. That means price hit it once, twice, 3 times, whether the trend is up or trend is down, and then gapped above or gapped below. A Mazuring gap, and I'll get into why they call it a Mazuring gap, and today they call it a runaway gap, okay, occurs after price has gone sideways for a period of time. So how long is a period of time? Where you have 3 touches of resistance or 3 touches of support, and then price gaps away from that support or gaps away from that resistance. See, the gaps themselves have different outcomes when you start to trade them. Okay, and they can help if you know the expectations and what type of gap it is. Is it a natural gap, a natural breakaway, or a natural runaway? Is it an exhaustion gap? Is price gapping up or down inside or outside the prior session's range? Okay. See, all of these are questions, okay? But once I start to expose you to each type of gap, you will then be able to manage expectations quite easily around market conditions, especially with the exchange traded funds where I check the gaps each day. The exchange traded funds move before the futures move. the exchange traded funds do not trade 24 hours a day. So the futures will adjust price up or down to the exchange traded fund around the session open. Okay. And by recognizing that, if we have a breakaway gap, often price comes back about the middle of the range and then fills it halfway and then resumes whatever the higher time frame trend is. With runaway gaps, we don't often see price coming back to fill the gap the same day. But what does it look like when it does fill? Well, it usually comes all the way back and exceeds the gap area a little bit beyond it. Okay. The exhaustion gap happens late in the trend, and the exhaustion gap happens after you've had a breakaway, then the measuring or runaway, and then the exhaustion gap. So there's three types of gaps in a trend, and they can act as a map to help you understand where you are in that trend. Now, for futures intraday, usually the futures trade 24 hours or virtually 24 hours, okay, a day. So we don't often see the gaps on futures products. Now, we can take a gap from the prior session's 5 p.m. close to where futures open in the regular session. That area determines the gap. And what I map out in my pre-market, okay, I see the 5 p.m. close where I have the prior session's close, okay? Then I recognize whether futures have traded outside the prior day's trading range or if they're trading inside, okay? And there are some other rules that we will cover throughout our live trading room sessions about that. Now, if futures gap up or down inside the prior session, those gaps often fill the same trading day. Okay. If they gap outside the prior session's range, okay, they don't often fill the same trading day. They can, but it's less often. Okay. Intraday, if futures are an inside day and price is not broken above or below the prior session's range, very, very often that gap fills the same day. Now, when you're looking at a continuous chart, you're not going to see the gaps. That's why I marked them on the chart. Okay. For crude oil, nat gas, I like to look at the 5 p.m. close and the pit close. And I use that range as a place where potential profits can be taken. And if there is a qualified zone, we can take a trade there as well. Okay. But it's an additional study. I don't know whether to rely more on the pit close or the 5 p.m. close, so I'm documenting both of them. Okay. And if you guys have any questions, just ask in the chat. Okay. All right. So a natural gap, also known as a common gap, no major event that precedes a natural gap. Usually it's a relatively small gap, and generally they get filled relatively quickly or within a couple of days. They tend to be accompanied with normal average trading volume. Now, if you have a gap up or down on a very high volume or very light volume, those are ones also to take note. If it's a gap down or up on very light volume, well, then you can say, hey, they don't have a lot of their orders. They're looking for buyers, looking for sellers, and price is moving to find those areas. Natural gaps are a lack of buyers or sell orders around the prior settlement price and algorithms looking to make a market by matching existing buy and sell orders at the session open. Okay. A rollover gap. Mostly it pertains to futures traders. Okay. Because we don't have rollovers in stocks or Forex and stuff like that. Specific to futures, rollover gap is a result of price adjusting for the new front month contract the back month contract still has holding costs, insurance fees, and etc. Okay, so why price gaps up or down is because the price differential from the price has a premium built into it for the back month contract. Because as futures traders, we know that every futures contract expires right where the cash product is trading. And the longer the futures product trades, the closer it gets to that cash value. Okay. Why price gap between the front month and the back month? Well, the price difference is a result of holding fees, carrying cost, insurance fees for every futures contract that expires at the spot price. When the back month becomes the new front month, the price difference will leave a gap in price. Now, I'm still studying these to see if there's a trade opportunity in them, but I tend to avoid those. Okay. A breakaway gap. Breakaway gaps are a strong movement in price that occurs when the price gaps above a support or resistance line, or breakaway gaps often seen early in a trend when price moves out of the trading range or following a trend reversal. Okay. Something that's been significant, something I've documented for many years on the S&P futures, is that when we've had two major gap downs within a 10-day period, and we've already had it, that often starts leading to a bear market. Okay. Two very sizable gap downs on the S&P futures over a 10-day period. Okay. Now, to help you qualify a breakaway gap, breakaway gaps is a gap away from the existing trend. Okay. So in order to identify a trend, it takes 2 points. In order to confirm a trend, it takes 3 points. So to help me determine if it's a breakaway or measuring gap, I like to have 3 touches of support or 3 touches of resistance, and then price gaps beyond those levels. A breakaway gap, here we clearly see the price was trending up. 2 points identified, 3 points confirmed, and then price gaps down. At this point, I would also encourage you, since you're starting to collect data on this, is document the size of the gap. There will be small gaps where you'll say, I'm not working, okay. And then there'll be very large gaps, which gets you more engaged, okay. When you document how big the gap was, and then you say, okay, well, it's this big, and then to follow up with that, find out how long did it take to fill that gap? That was X amount of points. You will start to see that if it gaps up or down X amount of points, and it takes 15 minutes, 30 minutes, midday, or end of day, or not for several days when it comes back to fill the gap. Now that's going to take time to collect that data, but the earlier you start on that while you're watching the gaps, the more prepared you will be to take action when you see a gap up or a gap down. And whether that gap up or down is a breakaway gap, a runaway gap, a rollover gap, okay, or inside outside day gap, okay. Measuring gap, also known as a runaway gap, okay. Now, these generally happen in a sequence. And the word measuring gap is derived from a gentleman named H.M. Gartley. He wrote a book, How to Profit with Stocks. The book was published in 1935. Still holds true on what's going on with price today. So a measuring gap makes a significant spike in either upward or downward direction, often occurred during a trend and reinforce the direction of the trend. Usually catalyzed with an unexpected news story. and traders don't want to be left behind and refuse to let price retrace. Okay. So breakaway gaps often occur first, followed by measuring gaps. And then at the end, you're going to have an exhaustion gap. Now, the reason H.M. Gartley called it a measuring gap is because you take the distance of the measuring gap to the beginning of the breakaway gap, and that accounts for 40% of the estimated price move. The other 60% is to the upside. They've been using this since the 1930s, or well, that's where it's documented anyways. So somebody's been doing pretty well with this, using gaps. The last one here, an exhaustion gap. The exhaustion gap occurs when a number of available buyers and sellers runs out, leading to a gap down or up, respectively. This technical signal marks potential change. So anytime you see a gap, you need to kind of back away from the picture and say, all right, where are we on the map? Is this a breakaway gap? Is it a measuring gap? Or is it that exhaustion gap? Okay. You can include your trend analysis and breakaway of a trend. And so there's so many variables. Right now, we're just saying, hey, if you recognize it's an exhaustion gap, that doesn't mean you short right away. It just means things are getting exhausted, top heavy. Okay. And they can continue to keep going up. But you become more defensive once you know it's an exhaustion gap. This technical signal marks a potential change from an upward trend to a downward trend, or vice versa. The gap will often violate a previous trend line, okay, trend line break. When price breaks a former trend, it creates an opportunity for traders who want to be participating in the early stages of a new trend. Now, be aware that a fresh accumulation of sell orders may not yet be created to take a supply and demand trade for a trend change, okay? But you start seeing the making of that, okay? False signals, not all gaps lead to predictable outcomes. Sometimes gaps don't get filled as expected, and the trend doesn't continue as projected, like rollover gaps, okay? Market volatility often gaps often occur in volatile market conditions, increasing the risk. So gapping up or down on light volume is where you're going to see most of that volatility, okay? Gapping up or down on high volume would reduce the volatile or the volatility of the market. Overnight risk, in some cases, holding a position overnight to capitalize on or wait for the gap to fill can be risky, especially if the unpredictable events occur. Other odds enhancers and market conditions need to be considered when trading gaps. So it's not, most of this is not a place to make a trade. It's making you aware of the conditions, okay? So we've talked about several different types of gaps. We cover these extensively in our live trading room, Monday, Wednesday, Friday, and in our community trading room. We talk about these a lot as part of our pre-market routine. If you have not subscribed to our live trading room or our platinum package, which includes the live trading room, our community room, our community Discord group, and where we trade all together, okay? You can go out to themarketinstitution.com and get some more information on that. Well, that was your little distraction from the markets on this Friday. We are doing some more short takes on this every Friday after our live stream, and everybody is welcome to come and participate in those. Everybody have a great day and trade safe. Bye now.